Thank you for joining us today. I'm going to provide a little background on myself and then introduce you to Dan Katz. My name is Donna Eckel, and I'm going to just tell you I started my career in the accounting department working for a small to mid-sized manufacturing company. Operations was a big part of that job. I was helping in human resources, in payroll, sales, marketing, and technology. And after years of using kind of an antiquated green screen system for accounting, I researched different ERP systems and then implemented customized software for our company. This led to me writing training manuals for each department. And then I ended up training everyone in the company on how to use the software. That led to writing financial reports with SQL. So that I kind of had a good understanding of the business at that point after 8 years. And then after working for that company, I worked with another manufacturing company as a financial analyst, and then moved on to director of finance for a not-for-profit with a heavy concentration, again, in operations, and then budgeting was a big part of that. So with this background, it was fitting to become part of the outsourced accounting team here at Forbes Mazars. Our outsourced accounting team, we're a team of professionals backed by a lot of industry experience. And our team can help your business improve accounting operations and business processes. Some of the services that we do are digital accounting, technology assessments, operational assessments, accounts payable processing solutions, expense management, budgeting, fixed asset management, payroll consulting, and just general financial consulting and analysis. Now I'd like to introduce you to Dan Katz.
Hello, everybody. Thank you for joining us. Thank you, Donna. So my career path was almost the opposite of Donna's. I started in a small CPA firm in 2008, and through changes and acquisitions was part of the local and national CPA firms. And now I'm an assurance director of a global professional service network at Forbes Mazars. I have worked across many industries, but for the last 9 years, I'm primarily involved in nonprofits, associations, and higher ed. For a few years in my career, I switched the side. So I joined the dark side or the light side, depending on how you want to look at it. And I was a controller at a large nonprofit in Chicago. That helped me to get a better understanding of what the challenges the accounting departments are facing and how many things you need to juggle on a daily basis to stay on top of your responsibilities. So let's move to the presentation on 842.
Okay, so upon completion of this webinar, it does say will be able to, but you should be able to at least identify a lease, prepare an amortization schedule, complete an initial measurement of lease liability and ROU assets, right of use assets, and prepare monthly or annual journal entries to accompany the schedule.
Before we dive into the context, I wanted to say that unfortunately we cannot see anyone on our side of the screen, so it's really tough to get your reaction or to see if you have any questions. So please use Q&A function below, and we will address your questions either at the end of the presentation or after the presentation.
Very good. So part of the ASC 842 lease background, we're requiring a lessee to recognize all leases on the balance sheet. Before we could see items on the P&L for the expenses, but now we want to make sure that we've included the ROU asset and the liability as well. So this modifies the definition of a lease to focus on the ability of the lessee to control the underlying asset for a period of time. I also want to mention that this dates back to December 15th, 2021 for non-public entities. So this is an ongoing thing, whether your company does it now or whether your auditor may do it or some other means, this is being done because it's part of GAAP. So the other ASC impact that I wanted to mention, a lessor really doesn't have fundamental changes, but the lessee does have these operating leases that they need to recognize on the balance sheet now. And now finance leases, capital leases, there are fundamental changes to those either. They're still in the balance sheet as they were.
So before we proceed, I just want to make a little comment. So I know that we've been in this for several years now. There are a lot of literature available, but what we didn't see with Donna were plain English explanation what leases are for, and a lot of examples where you can walk from different scenarios. So this is the main goal of our presentation. Our presentation would be half of the time would be very high level overview of the new terminology, and then it will be examples and examples, which we all hope to cover in the next 45 minutes, 50 minutes.
We will cover it, Dan. So we're going to define a lessor and a lessee, and a lot of people already know what that is, but I just want to put it out there. A lessor is defined as an entity that enters into a contract, and they provide that right of use asset for a period of time. There are usually time limits on it and some other obligations, but the lessee is a business who rents that defined space, whether it's a building that they're renting or another asset. And Dan will get into his bus example in just a little bit, but that's the difference between the lessor and the lessee. And we're going to move on to our very first polling question. What are the most common challenges that your business is facing with the adoption and day-to-day application of ASC 842? Choice A, keeping leases organized in a central filing place and making sure that the list is kept current. B, preparing schedules on a monthly basis for those monthly journal entries. All the above, or challenges that are different from that for your company, or none of the above. We already have a system, our leases are recorded properly each period. Dan, as an auditor here, do you see one of these more than the other?
I am cheering for D, none of the above, and the systems are in place, but I suspect we might see other answers during this poll.
Yeah, so you'll have just a little bit more time to do this. I wish it was D also. Hey, actually, that's pretty good. 23.7%. They're already recorded properly each month. And it looks like all the above are challengers. Yes, we do see that.
So before we go any further, let's talk about what makes a lease a lease. So lease is a contract. So any lease is a contract, but not every contract is a lease. So what is a lease? A lease is a contract that conveys the right to control the use of identified asset for a period of time in exchange for consideration. This is a fancy terminology, but what does it mean in plain English? So you have an asset that you can identify, that you have rights to control this asset, and there is some consideration is involved and you pay for this use of an asset. And the example that I use a lot are the school buses. So let's say you have a company whose business is to pick up kids from school, from homes, and drop them off to school in the morning, and then pick them up from school in the evening and drop them off at home. And then on the weekends, you use those buses to give a tour to the city of Chicago, which is a beautiful city. And let's say you decided not to own the buses, but you lease those buses. So let's say you have an agreement where you have 3 buses with known VIN numbers, and you use them exactly as intended, Monday through Friday for school, and weekends you're doing tours. So I would argue in this scenario, you have a lease agreement because you have identified assets, 3 buses with known VIN numbers. You use it the way you want, and some consideration is involved because you pay the landlord for the use of these buses. But let's switch it a little. Let's say you have an example where a landlord has a fleet of buses, and every Monday you pick up a different bus. It's the same function of a bus, but it's not the known bus. It's just a bus out of many that the landlord owns. So I would argue that even though the conditions are pretty much the same, that this is a contract, but it's not a lease contract because you don't have identifiable asset. You just have the right to get a bus, but you don't have the specific asset that you can identify. And this, let's switch it a little bit for our last example on this topic. And let's say you get 3 buses with VIN numbers, but then for agreement, you can only use these buses Monday through Friday only to pick up kids and drop them off at school, but you cannot use it on the weekends to do the tour of the city of Chicago. I would argue that this is a contract, but it's not a lease contract because you do not have full control of the assets under the agreement. So once we determine if the contract is a lease, we need to make a determination and classify this lease. And the options are that the lease would be either a finance lease, formerly known as a capital lease, or it's an operating lease. In all simplicity, if the lease is not a finance lease, then it's an operating lease. So what makes the lease a finance lease? And this is very similar to how it used to be under the scope of 840, the old regulations. So if there is a transfer of the ownership at the end of the lease, then this is a finance lease. If the lease has an option to buy this lease at the end of the lease term that the lease is most likely to exercise, then it will be a finance lease. And when we talk about reasonably certain to exercise, it most likely means that the price at the end of the lease is favorable. A good example would be copier lease with a $1 purchase option advantage. So the other criteria would be that the lease term is for most of the economic life of an asset, or the present value of the sum of these lease payments equal or more than the fair value of the underlying asset. So once we classify the lease between the finance and operating lease, let's talk about the important dates on the agreement. Let's talk about lease commencement date and lease inception. Lease inception is the date when you sign the lease, and this is the date when you determine if you have a contract or if you have a lease contract. The lease commencement is the date when the lessee gets the right to use the asset. The ownership is kind of being transferred for the term of the lease. And this is the date when you determine your classification and you determine if it's an operating versus finance, when you measure your lease liabilities and ROU assets, and this is the date when you record lease liabilities and ROU assets on your books. So in addition to the above, we talked about determination if the agreement was a lease. If yes, we would classify it as a finance or operating. And now we need to determine the term of the lease. And the term of the lease would be the non-cancelable period under the lease, plus additional periods you would reasonably certain to exercise. So non-cancelable period is ultimately the period when the contract is being enforceable, and it would cause significant penalties for both parties to exit the agreement. What changed between the old 840 to the new 842 guidance on leases is the terminology of reasonably certain. So if you have a lease term, let's say 5 years, and you have 2 5-year options to exercise, you need to determine if you're reasonably certain to exercise this option. And that would mean generally more than 75% certain. So what are the factors that would make this determination and you can conclude that you're reasonably certain? Probably the most common one would be that you have a lot of leasehold improvements associated with your place. You heavily invested in the lease. And other options would be extremely favorable price, or sometimes you just cannot afford business interruption, so you most likely will stay in this place. And if any of these conditions are met, then you would include the additional options under the lease as a term period for this lease. I also want to briefly touch about short-term leases. Short-term leases are defined as leases of 12 months or less from the commencement date until the expiration. So short-term leases are excluded from the scope of 842. So if you have a short-term lease, you don't have to capitalize. So let's now move to the next slide. And
actually, Dan, I'm just going to jump in for 1 second. I do see there are some Q&A, and feel free to type a question in there. And I believe you just answered one of the questions because they were asking about month-to-month leases. So that is not considered.
Awesome. I didn't even see this, but great. So we have a question on how your company currently organizing and storing your active leases or amended leases. So A, we maintain the physical copies in secured filing cabinet in our office. B, our leases are stored in a document management system with access control. C, all leases are managed through our ERP system. And D, we provide a stack of agreements to our auditors at the end of the year. And then there was a question before we even started this. On evergreen leases, which are the leases that automatically renews. So even if the lease automatically renews, it doesn't mean that you're reasonably certain will exercise an option. So I would still go through the normal determination of the original term of the lease plus available options to make sure that that you include in the right term for the calculating of lease liability. That's awesome. Almost half our leases stored in the system with access control. That is amazing. So let's go to the next slide. Donna?
Very good. Yeah. So lease payments, I'm just going to cover this quickly because it's written in the lease agreement already, but they're either fixed amounts or variable amounts. And fixed amounts are listed as the number that's in the lease. So it may actually fluctuate from year to year. That's still a fixed amount. So if your lease agreement says that you're paying $2,000 a month, and then in the first year, and then in the second year, you're paying $2,500, that's still considered a fixed amount. So we can definitely build a schedule off of that. Variable amounts, there are some variable amounts that are used. Oftentimes utilities or property taxes are part of the variable. I do have one example that is very common. Copier machines, those are variable leases, or they're variable amounts that get on there. Obviously, with a copy machine, you don't know exactly how many copies are going to be made or scans. So oftentimes there are additional charges for the number of copies you make, or sometimes you're going over the limit that they originally set with their ink. So with the variable amounts, it's a little harder to calculate exactly what needs to go on there. And then
So
Dan.
So we talked about determination if an agreement is a lease. We talked about lease classifications, we talked about lease terms and lease payments. And now we're going to talk about discount rate. And you might ask yourself, why do we need to know all of this? Well, all that information would be needed to calculate lease liability, which we are covering on the next few slides. I want to also say that we're almost done with the high-level overview, and we're about to dive into the world of examples, and I'm really excited about it. I hope you are as well. But if you need a little bit of energy boost, now is the time to grab a cup of coffee, and we're ready to start crunching some numbers. But not yet. Let's talk about discount rate. So just by the way the formula is done, the higher the discount rate, the lower your lease liability would be. And that is because your lease liability is a future payments discounted at a rate. The higher the rate, the lower the liability. If the lease agreement that you have listing the implicit rate, then you must use the implicit rate. However, I'm yet to see an agreement where a landlord is telling you exactly what your markup is for the property that the landlord owns. So this is very rare case, and I haven't seen much of this type of leases. So if this option is not available, then you're left with two other options. One is the incremental borrowing rate, which would be going to the financial institution and trying to get the rate that they would charge you for the same length of your lease terms and for the same dollar amount. That option is available, but it still requires you to do a lot of extra steps. The best and the simplest option that is available for not a public businesses would be to use the risk-free interest rate, which is available on US Treasury website. That information is readily available. It gives you different ranges, so you can pick 10, 5, 15, 20, 30 years, and it goes back to many years, so you can pick the exact rate that you need for your lease. So next slide, Donna.
Yeah, so a few nights ago, I was going over the slideshow, and my son had asked more about what are you doing? What is this ASC 842 thing? And so I came up with a slide, and a lot of people already know this, but I just wanted to kind of go over it in the most simple terms, in the terms I used with him. So lease liability. Basically, it's a fancy word for when someone lets you use something, right? You might let them use your iPad or your bicycle. You're borrowing it. but there's rules attached to it. And when you borrow the toy or the bike or the iPad, you promise your friend, right? I'm going to take good care of this and I'm going to give it back when the time is right, because there has to be some date when you're done using it. And the promise is basically lease liability. You're saying, I promise I'm going to take care of this, and here are the terms that you gave to me, and I'm going to return it on time. Right of use assets, or ROU assets. Now, imagine with that toy, you have a special sticker and it says, I can play with this toy. That sticker represents your right to use the toy. So in accounting, it's called the right of use asset. It's basically saying, this toy belongs to me just for a little while and just for the terms that you set on it. And then as far as the balance sheet goes, that was a little harder to explain. But basically, if you have a notebook, you write down all the important things. And people here who are in accounting, that's what we do. We write down all of the important things on our balance sheet. And so with 842, we have to record the right of use asset. So the sticker that's saying you can use this. And then the actual lease liability is the promise that you're giving it back. So that's also on your balance sheet. So basically, it's like keeping track of an iPad or borrowed toys.
So let's talk about the measurement of the leases. And the first step in calculating your leases is calculating the balances that you're going to put on your balance sheet would be calculating the lease liability. And in order for you to do the calculation, ultimately all of the things that we covered before would be coming together here. So in order for you to calculate the lease liability, you need to know the future payments, you need to know the terms, and you need to know the discount rate, because the lease liability is the present value of all your future payments. And that is why it's extremely important to get the terms right, because if you have the original term of 5 years and you have options to extend, if you're reasonably certain that you're going to extend, your future payments will be a bigger number, and as a result, your lease liability is also going to be a bigger number when you do your calculation. So once you do your calculation and you calculate your lease liability, the next step will be to calculate your right of use assets. And a lot of time, lease liabilities and ROU assets are exactly the same. So the things that might change your ROU assets would be the initial direct cost, lease prepayments, lease incentives, and we'll talk about those later. But normally, again, you calculate your lease liability, this is your step one, and then any other changes that happen because of the lease agreements or something outside of the lease agreement will be impacting your ROU assets. So lease liability, again, is just the future payments discounted at a certain rate. And then the last step is to calculate your straight line lease expenses. And the straight line lease expense is going to be your future payments divided by the number of terms. Before we move to the examples, I want to talk a little bit about two things, about security deposits and prepaid rent. A lot of leases have security deposits. And if the security deposit is there just as a collateral, where it will be returned back to you at the end of the agreement, you don't need to include this balance in your calculation of your lease liabilities because you're getting this money back. However, if this security deposit, in a sense, a prepaid rent, where it will be used to partially cover one of the future payments, then that will impact your lease liability, because this lease liability will be reduced by the prepayment amount, and it will impact the entire calculation of lease liability in ROU assets. So this is something for you to watch for. And now we're ready to dive into the example. So let's take it easy. The first example that I have is a 5-year lease with no changes in the lease payment. So you pay $25,000 annually, and it's paid at the end of each lease. Your discount rate is 3.93%, which is the discount rate as of January 2nd, 2024, taken from the U.S. Treasury website for the 5-year term. So your utilities are 10% of the bill, and your security deposit is $5,000 to be returned at the end of the lease. So in order for us to figure out, to determine the lease liability, we need to figure out what numbers we need to use in our calculation. So as Donna covered before, we're looking for the fixed payments that are part of the lease agreement. So the payments that you pay of $25,000 per year, this is a fixed payment that's given to you. But then we have utilities at 10%, so that's a variable cost because we don't know what this total bill is, so we can completely disregard it from our calculation. And same goes for the security deposit, because even though we paid $5,000 already, this money will be returned to us at the end of the lease, so we don't want to factor it in our calculation. So the only fixed numbers would be annual rent payment. So in order for us to calculate lease liability, we would look at the future lease payments of total $125,000, which is $25,000 per year times 5 years, and we discounted it at an interest-free rate of 3.93, and then it will give us a lease liability of $111,550. Since we don't have indirect costs, lease prepayments, or any lease incentives, our ROU assets are going to be exactly the same, also $111,515. And then the last step would be to calculate the rent expense, which would be $25,000, and we calculated by taking the total lease payments of $125 divided by lease terms. And now Donna will walk us through the journal entry.
So we're going to take the information from Dan's schedule that he just did and build it into our schedule here. So we're going to create the journal entries. And when Dan said that the lease liability was $111,514 after the present value discount, we can see it highlighted in the fourth column at the top. So in period 1, which happens to be year 2024 on here, if we just look at the first line all the way across, we can see cash, beginning balance, liability, payments, ending, beginning, and then the lease expenses at the end of this. This is all we need to create our journal entry. So our first journal entry, we want to make sure that our balance sheet is hit. So ROU assets, we're putting that on the books at $111,000 based again on that lease liability that Dan calculated. And then the liability also needs to be on the books. So 111,000 gets on the books. And our second entry is to record rent expense for the period. So we know that it's $25,000 a year. Maybe it's going to be 12 entries, so 25,000 divided by 12 on your books. But for this particular schedule and period, we know that this is 1 year of rent expense, 25,000. So we're going to credit that ROU asset. So it's almost like depreciation of our asset as we use it. So 25,000 is credited, and then of course we need to pay. So in this scenario, and we'll see others that are different where the cash is different from the actual expense, but for this one it's pretty basic. Our cash, we're going to credit 25,000, and we're going to lower our lease liability by 25,000 now. And then we can't forget to record the present value discount. So the ROU asset, $43.83, and our lease liability is credited, $43.83.
So before we go to the next slide, I just want to chip in a little bit. So when I saw a bunch of videos several years ago, I was really confused on why we're making those journal entries, how they're going, what's going on. So for myself now, as Donna mentioned, I'm looking at your rent expense and ROU assets ultimately as a fixed asset that is being depreciated the same amount month after month, period after period. I'm looking at the lease liabilities for the operating leases. It's kind of like a mortgage. You make a payment, you reduce the principal balance, but then this journal entry 4, this is the true up that brings the interest up. But again, it's a weird interest because it's not impacting your P&L. It's a true up between your assets and liabilities to make sure that the discounted rate is being properly accounted for in this amortization schedule. So let's go to the example 2. So we're making one change to this. So instead of $25,000 without any changes, now we're adding the escalating terms. So our future cash payments increased. So now instead of $125,000 in the first example, our total payments are $152,628 in the lease liability column. Discounted at present value that give us the lease liability balance of $135,167. Again, we don't have any other factors such as indirect costs, lease prepayments, lease incentives. So our ROU assets are going to be exactly the same as our lease liability, but what changed would be our straight line rent. So now they'll take the total payments based on the lease agreements, which are $152,628. We divided by the lease terms of 5 years. And our straight line rent expense is going to be $30,526, and Donna will walk us through the journal entry.
So this is very similar to the last entry, but because there's escalating terms, which are actually very common, we can see that the payment column is 25,000 in the first period or the first year, and then it went up to 27.5, up to 32.50. So this amount is fluctuating, it's increasing. So when we create these journal entries and we create the schedules, we really need to be careful not to keep adding the exact same amount. We need to be aware that in year 2, it's going to change. So I'm going to jump to the cash section in here in journal entry 3. And in the first year, in the first period, we have 25,000, but the second year, our cash is going to be 27.5. So make sure that you're following the schedule and not just the journal entries that were created. So in here we have, again, journal entry 1, ROU asset, and we have that beginning lease liability of 135,000 that Dan created previously. And we also want to make sure that lease liability is noted on our balance sheet. So that's on here. Our rent expense, it is not 25,000. It seems like it should be 25,000, but based on the schedule that was created with the present value discount, our lease expense is going to be the same amount every period. So for the 5 years, it's always going to be 30,525 or 526. So that is entry 2. And then we did entry 3 and journal entry 4. Again, we're making sure that we record the present value discount. And as Dan mentioned earlier, this is found on the Treasury site. So if you don't know your present value discount, you can come up with it on here.
So let's add more to the lease example that we have. And again, the main point of this presentation is to go through the examples. So I'm still pretty excited about all of this. So we have the escalating terms, nothing changed from the example 2. But now let's say that your utilities are no longer 10% variable, but it's a fixed dollar amount of $1,000, and let's say the remaining balance will be a proportional share between the tenants, if we're talking about an office space. So now we have a fixed utility payment that should be baked into your lease payments when you calculate the lease liabilities. So when we look at the schedule, the only change from the previous example is that each year payment increased by $1,000, and the total payment got slightly more by $5,000, which resulted in a small change in the lease liability. So our future payments are $157,628 in the lease liability column, and the discounted balance is $139,628. Again, no other factors that would impact the calculation of ROU assets. So our ROU assets are going to be exactly the same as lease liability at $139,628. Now, when we calculate rent expense, we are looking at the future lease payments and discounted payments, and we divide it by the lease term. So the straight line expense is $31,526, which is $1,000 more than in the previous example, and that is because we have this fixed utilities that we included in our calculation of lease liabilities and ROU assets. And now back to Donna to walk through the journal entries.
Basically, this is like the last entry, but I do want to mention that slides will be available after our presentation today. So if you're taking screenshots, I understand why you would, because these entries are not necessarily easy to make. Once you get the hang of it, it's not too bad, but we do have 6 examples because terms do change on each of these lease agreements. So again, escalating terms and fixed utility payments for this one, not much different with our journal entries. We're recording the ROU and the lease liability based on Dan's schedule. In this case, it's 139,000. We're doing our rent expense, which is in the far right column. It is 31,525 because it's straight line. And then we have journal entry 3, it's our cash, and make sure that you're looking at that payment column when you're doing this, because we don't want to pay the landlord the wrong amount. We don't want to pay them $31,525. We want to make sure we're paying $26,000 this year, $28,500 the next year. And then again, ROU assets and lease liability need to be recorded based on the present value discount that was calculated.
So another example, again, we're building up on what we have. So same exact terms as in the previous example, except for the security deposit that you had is now not just a security deposit that is a collateral, but it covers the last month or the last period of the lease. So we have a security deposit of $36,000, 603, and that will impact our lease liability calculation because this is a payment that we no longer have in the future. So when we calculate our lease liabilities, we start with the same balance as in example 3, and everything stays the same until year 5. And year 5 is only $1,000, which is the utilities, because the rent payment for year 5 was already paid with the security deposit. So our total future payments are $121,000, which would give us a lease liability of $109,442. Now, when we calculate our ROU assets, we do have a lease prepayment that we should factor in. So we start with the lease liability balance with $109,442, but then we need to add the lease prepayment of $36,603, which will give us the total ROU assets of $146,045. And then when we calculate our straight line rent, we still start with the lease payments that show in the future payments per agreement of $121,025, but we also need to add lease prepayments, $36,603. Our total payments will be $157,628, which divided by 5 will give us a straight line lease of $31,526. So if you go back to example 3, our straight line expense didn't change at all, even though in one example we were making payments on an annual basis, and here we're making a prepayment before the beginning of the term. But that did impact our lease liabilities and ROU assets. So now Donna's going to walk us through the journal entries.
So there's a slight difference on this journal entry than the last ones, and that's that security deposit. We want to make sure that when we record the initial entry, our ROU is 146, and our security deposit gets credited 36,000, and then lease liability on this one is 109. So it's initially a little bit different, but then we continue recording on the straight line basis. So rent expense is already calculated for us from Dan, and it's 31,000. And then just again, make sure that cash payment is according to the schedule. And in this case, year 1 is 26,000. And of course, the present value discount needs to be recorded. We're on to polling question 3. What tools are you and your company utilizing for the preparation of the lease liabilities and right-of-use assets amortization schedules? A, we utilize Microsoft Excel with custom templates to handle the prep of these schedules. B, we use third-party systems for managing lease liabilities and amortization schedules. C, we outsource this accounting function to a CPA firm. D, our auditors provide us a journal entry at the end of the audit to adjust lease liabilities and right-of-use asset balances.
So while we're waiting for the results, there was a question on the security deposit. So if you have a security deposit that is just a collateral, you don't include it in the calculation. If you have a security deposit that becomes a prepayment, as it was shown in the previous example, then it will impact the calculation of the lease liability. And yes, it will be added. So if the security deposit is a prepayment, it will reduce your lease liability because it will be taken out of the future payments that you're using for the calculation of the lease liability.
So it looks like most people are utilizing Excel and creating their own schedules to record. So that's good.
So let's go to the next. Ooh. Oh, I think I did something that I was not supposed to be doing. Let's talk a little bit about lease incentives. So a lot of time in the lease agreement, you might get an incentive to sign a lease. And a most common example would be the tenant allowance, and it is specific for office space rental, where you can move into a space and you have X amount of dollars that the landlord will reimburse you for, that you can make this space yours and make the changes. There is a little bit of judgment involved, because if you move into a space and this tenant allowance is being used for normal upgrades, like you're moving into empty space and you just need to do the wiring, you need to paint the walls, I would argue that this is not very specific leasehold improvements and just an expense to make the space livable. However, if you're moving into a floor that is completely empty and you bring the architect and you work on different things, you make the offices the way you want, you make the lighting exactly the way you want, and you do all these improvements, then it would be legitimate leasehold improvements. So 842 covers scenarios where you incurred the expenses and you receive the reimbursement from the landlord, or you incurred expenses and you have a receivable from the landlord at the commencement date. If you have received the payment before the date, then it would not impact the calculation of lease liabilities, but it will impact your RUSs. And if you have a receivable at the commencement date, it will impact your lease liability, but then RUSs would not be impacted. And we have example on that later. There are other scenarios where you have tenant allowances, but you haven't used them until the commencement date. And those examples are not necessarily covered under 842. There are other guidance. So it wouldn't be part of this presentation, but if you have a question on this, please post in Q&A and we'll reach out to you and we'll walk you through this one. So let's go to the next example. So this is not a tenant allowance example, but it's another one that is pretty common. So let's say you have a 5-year lease, you still pay $25,000 a year, but then your first year is free. There is no payments for that year. So you will be doing exactly the same calculations as you normally would. Your first step would be to calculate your lease liabilities. You will start with the future payments of $100,000. You're making only 4 payments of $25,000. And then you will discount it at 3.93% to get lease liability of $87,460. So the next step is RUSs. Again, there are no prepayments. You didn't receive incentive in the form of money, so there is nothing else impacting your RUSs. So your RUSs is going to be exactly the same as the lease liability. It would be $87,460. But now when you're looking at the rent expense, even though you're making no payments in the year 1, your straight line expense is irrelevant of the actual payments you're making, and it would be $20,000 a year, future payments of 100 divided by 5 years. And now Donna's going to walk us through the example.
One of the things I want to note on here is that even though the first year or the first period looks like it's free because you don't have to pay cash, and again, you can see journal entry 3 on here, cash is 0, lease liability is 0. That doesn't mean your P&L won't be hit. So on here, we want to make sure that lease expense is always $20,000 because again, it's straight line, and we're going to record $20,000 of expenses in each of those 5 years, even if they said your first year is free. And again, this comes from the calculation that Dan made on the schedule. Your ROU asset is $87,460. It's that beginning liability that we have, and our lease liability is credited. Rent expense, again, $20,000, even though our payments are $25,000. So for journal entry 3 in year 2, we have to make sure that we're paying $25,000. The first year we didn't pay, but we still need that lease expense every year. So our P&L is adjusted, and so is the lease liability and ROU asset as we move forward with this one.
So this is our last example. We're almost done with this, and I'm a little bit sad about it, but I know it was a lot of information. So this is the one with the tenant allowance. So all the information in example 6 is exactly the same as example 2, except for we received a lease incentive of $15,000 for tenant allowance that we used before the commencement date, and we received the money before the commencement date. Because that's the case, our lease liability calculation is going to be exactly the same as it was in example 2. We'll take just the future payments as they spelled out in the lease agreement, and the total payments would be 152,628. We discounted at the present value to get a lease liability balance of 135,167. And now we move into the calculation, second step of ROU assets. So ROU assets would be different because even though, and again, we start with the lease liability as our first step, but because we received this $15,000 beforehand and it was our incentive, that amount will reduce our ROU assets. So we start with the lease liability, we reduce it by $15,000, and our ending ROU assets will be $120,167. Similarly, we will reduce our total future payments by the incentive we received when we calculated straight line rent expense. So we take the total payments, undiscounted payments of $152,628, we subtract $15,000, and then we divide that balance by 5 years to arrive at a straight line lease expense of $27,526. And now Donna will walk us through the journal entries.
This one is slightly different because we need to make sure we record the leasehold improvements. So when the tenant allowance to leasehold improvements is paid out, we're fixing up the space. We put $15,000. We debit that for leasehold improvements, and then of course we paid $15,000. So we're crediting our cash. But then the landlord is going to reimburse, thank goodness, for that amount, and $15,000 cash comes back in. But now our ROU asset is credited. And then we need to make sure, as usual, we record the ROU asset and the lease liability. So in this case, it's $135,000, as Dan calculated. And then as we go through, it's pretty basic. Our rent expense is the straight line amount over in the right-hand column. Our ROU asset is essentially depreciated, so it's the same amount as our expense. And we're paying out $25,000, and our lease liability for that first year is $25,000. And then we need the present value discount again. So this one, again, it's very similar, but very common, again, for leasehold improvements. And we just need to make sure that they're recorded like this.
So we're almost at the end of this presentation, but I want to talk about a thing that is very common comes up. So these are the leases under common control, related party leases. And usually there are two types of issues. Issue number one is that 842 was created for third-party leases where the terms are enforceable and there are significant penalties for exiting the lease agreement. And that is typically not the case for the related party leases. So with 842, you can use a practical expedient to kind of bypass this enforceable term and just look at the written terms of the lease to determine if you have a lease or not, and then use this lease agreement to determine the classification in the account. So if you have a company that is own a building and renting space and there are no enforceable terms, you can still conclude that you have a lease. So another issue, and it's not specific to related parties only, but it's related to 842 and how it was adopted. And the issue is related to the leasehold improvements. So before 842, leasehold improvements were amortized over the shorter of either the useful life or the lease term. And that is still true for unrelated parties. However, for the related parties, you can continue amortize the leasehold improvements over the useful life, even if the lease term is shorter, given that the lease still controls the asset. But let's talk about the related parties. A lot of related parties enter and unrelated parties. So if you do the determination of the lease and you determine that you do not have a lease, then you should not have a leasehold improvements on your books that are associated with this lease. Similarly, if you want to avoid recording lease liabilities and ROU assets and you arrive at the conclusion that you have a short-term lease that is excluded from the scope of 842, then you don't have to record lease liabilities and ROU assets. But then your leasehold improvements should be fully amortized by the end of the 12 months. And if you have the leasehold, a short-term lease, but you have options, then again, you need to go back and determine if you're reasonably certain to exercise these options, which probably would be yes under the related party leases, and then you would still have to record lease liabilities in RU assets to keep amortizing leasehold improvements over useful life. So the sweet spot, and we see this a lot, the sweet spot for the related party leases is you're looking for something where you don't have to record lease liability in RU assets, but then you still want to continue amortizing your leasehold improvements over its useful life. So the best scenario would be to have an arrangement or agreement which is cancelable by either of the parties with a notice period. So you have technically a short-term lease, but you can't cancel it on a given day. You need to give a 60-day notice or 90 days notice. And then ultimate conclusion would be that you have a short-term lease, but then it can continue indefinitely. So you wouldn't have to capitalize leasehold improvements in RU assets because you have a short-term lease. And you can use useful life of an asset for the amortization. So now to the last slide, I believe.
Yeah, so best practices and controls. From my experience in the field, these are the most important pieces to make sure that your journal entries are correct before the auditor looks them over. And with these, good data in is good data out. And if it's reflected originally, then what you're going to get is a positive reaction from your auditor. But to make sure you're following these, there are 4 basic controls: transaction, IT, activity, and financial reporting controls. In transaction controls, what are the policies? So be clear who's authorized to sign. It is one of those things that it's easy to get a lease and you sign the lease, you throw it in the drawer and you think you're done with it because suddenly you have a copy machine and it's working. But typically, when the auditor will ask for that copy of a lease, we don't want it in the drawer, right? We want to make sure we know who signs the leases so that those authorized signers have the lease in the right place. So typically the president, CEO, maybe an executive director, or CFO are designated and authorized lease signers. IT controls, so make sure that there's a central filing system for your leases with proper rights associated to that file. When you save it on a drive, maybe you don't want everybody to see that lease, but you do want to make sure that the right people are seeing it, which is also related to the activity controls here. Signers have a clear and concise direction of that lease and who should be sharing it and who should be seeing it. And we want to make sure that notification to the correct people is in place. So do you need to let your administration know, operational departments, and then of course the accounting department to make sure that it's on your balance sheet. And the accounting department will assess, they'll calculate the schedules, and then record the monthly journal entries or maybe annual journal entries. And then we do have one more polling question, and we'd like to know if you'd like to be contacted by Forbes Mazars, covering any of the content or any other needs. So yes, I'd like to get more information regarding schedules for 842. Yes, I'd like to learn more information to identify a lease. Yes, please reach out to me about preparing monthly journal entries. Or no thanks. Dan and I are available. Our contact information will come up shortly. And my email is donna.eckel@us.forbesmazars.com, and Dan is dan.katz@us.forbesmazars, and we can help you, or another professional within our company can help you.
So thank you very much for joining us. It's been a fun ride. I know it's been a lot of information, and I know we didn't have enough time. So again, please feel free to reach out to us, submit your Q&A questions. We'll get back to you within a few days. And again, thank you for joining us.
Thank you.